Hi everyone, very good evening. So welcome you all to the day 2 of the costing revision for CA Intermediate September 2026 attempt. I welcome you all for the day 2. So all those who are joining in, please let me know in the comment section if audio and video is clear, guys. Please let me know in the comment section if audio video is clear. Quickly join in, share with all your friends. Okay, so we'll wait for 2 minutes so that everybody joins in and then we will start with our session. I'll update in the WhatsApp group also. Yes, good evening, good evening. Please confirm once if audio video is clear, Vedant. If you can confirm once, please. Good evening. Okay, all clear. Fine, fine, fine. Right, so if you have any doubts in the yesterday's session, please let me know first. Any doubts in the yesterday's session? So yesterday we ended at EOQ, right? So we discussed about the levels of inventory and EOQ. And today we'll start with this one question. Illustration number 6 is there. We'll start with this illustration on levels of inventory and EOQ. This is an important illustration from the examination point of view. So we'll start with this illustration number 6. Okay. Yes, everyone, please confirm if you are any doubts in the yesterday's session, please confirm once quickly. No. Fine. Okay, so we'll start with this illustration number 6. Now, one thing when we discussed about EOQ, now EOQ tells you what? The EOQ tells you that what is the quantity that should be ordered, and ROQ also tells you what is the quantity that we are ordering, right? So what I'm saying is there are two terms which you are using. One is ROQ, right? ROQ tells you what? ROQ tells you quantity ordered, right? And EOQ tells you what? The EOQ tells you quantity, tells you the quantity that should be ordered, quantity that should be ordered, isn't it? So normally what we say, normally ROQ will be equal to EOQ unless otherwise specified. If in a question it is specifically mentioned that the ROQ, the company, what company is actually ordering is different from the EOQ, in that case the ROQ will be different than the EOQ, otherwise ROQ will always be equal to EOQ. Right? That is why I've written here that for EOQ, okay, here we have done ROQ. Yes, this part. If you remember this part, if question is silent, then ROQ is equal to EOQ. That's what I told yesterday, that when I'll cover this when we will come to EOQ part. Right? So unless otherwise specified, the ROQ will be equal to your EOQ. Now we'll come to question. From the details given below, calculate reorder level. Right? Reorder level we have to calculate. Reorder level is what? Maximum consumption into maximum lead time. Reorder level tells you what? Maximum consumption multiplied by maximum lead time. Then we have to calculate maximum level. Maximum level is what? Reorder level plus reorder quantity minus minimum consumption into minimum lead time. Then minimum level we have to calculate. Minimum level is what? Reorder level minus average consumption into average lead time. And sometimes in the question the word used instead of average is normal. So it means the same. Normal. Right? So whether the word used is average or normal, it means the same thing. So do not get confused that what is a normal. Danger level is what? Average consumption into lead time for emergency purchases. This is what we have done about the danger level. Right? So reorder level, maximum level, minimum level and danger level. Let's see what is the information given. They say the reordering quantity. The reordering quantity is to be calculated on the basis of following information. Reorder quantity means they are talking about EOQ, that how you are going to calculate EOQ. Cost of placing a purchase order is ₹20. So for EOQ, this is your O. Cost of placing a purchase order. Number of units to be purchased during the year is 5,000. So this is your annual requirement, that is A. Purchase price per unit inclusive of transportation cost is ₹50. This is the purchase price given. Annual cost of storage per unit is ₹5. This is the value of C. Now instead of percentage, they have directly given you the value. Then the details of the lead time are given. Average 10 days, maximum 15 days, minimum 5 days. For emergency purchases, it is 4 days. And the rate of consumption is given. Average 15 units per day and maximum 20 units per day. Now, one thing that is missing in this problem is the minimum consumption. We will require minimum consumption, and that minimum consumption is missing. So how can you calculate the minimum consumption? You can calculate it from average and maximum. Average is given 15, maximum is given 20. So we can calculate from average. What is average here? So average is given as minimum plus maximum divided by 2. Right? You have average, that is 15. I'll take 2 here, multiplied by 2 is equal to minimum consumption plus maximum of 20. So your minimum consumption from here will be 10 units per day. Right? Now, one very important thing here that you have to remember, sir. Very, very important thing that you have to remember, that if your lead time is in days, then your consumption should also be in days. If your lead time is in weeks, then your consumption should also be in weeks. Very important point. With regard to this, what we are saying is that if lead time is given in days, then your consumption should also be in days. Consumption should also be in days. right? If your lead time is in weeks, your consumption should be in weeks. If your lead time is in months, your consumption will be in months. So both should be in the same time period. This is one point where institute can ask you to commit the mistake. They can give you the lead time in the days, but they can give you the consumption in the weeks. They can give you the lead time in the weeks, they can give you the consumption in days. This is where institute can force you to commit the mistakes, right? This is what we have to be very careful with. Okay, now for this, what will be the reorder level? Can you calculate the reorder level now? Yes sir, maximum consumption is 20 and the maximum lead time is 15. So maximum usage per period and into maximum lead time. Maximum consumption is given 20, maximum lead time of 15. So 20 into 15, 300 units will be your reorder level. Maximum level is what? Reorder level plus reorder quantity minus minimum rate of consumption into minimum lead time. Now ROL you have calculated. Reorder level you have just calculated as 300 units. ROQ, what will be ROQ? ROQ will be nothing but your EOQ. That will be 2 multiplied by annual requirement multiplied by ordering cost divided by 5. So it will be 2 multiplied by 5,000 multiplied by 20 divided by 5. That will come to 200. This will be your ROQ. That is what they have written. Refer to working notes. ROQ is 200 units. So ROQ is nothing but your EOQ. Minimum rate of consumption we have just calculated as 10 units and minimum lead time is given to you, that is 5 days. So you just have to put it 5 days, you will get 450. Minimum level is ROL. ROL you have calculated in the first part. Average consumption given, average lead time given to you. So 150 will be your minimum level. Then danger level is what? Average consumption into lead time for emergency purchases. Average consumption given, lead time for emergency purchases given 4 days. So 60 units. Right. So in this question, this is the important point, that the minimum consumption is not given to you. This is the important point of this question. And this question they have asked in the examination for 5 marks, right? This is how much marks? This is your 5 marks question that they can ask. Is this clear, everyone? Can we move to the next one? Please let me know quickly if we can move to the next one. Come on. Yes. Okay, so we'll take up one question from the practical questions. One very good question from the practical. Yes, question number 4 and question number 5. These two questions we'll take up, right? Question number 4 will take up and question number 5 also will take up. Practical questions, right? Not the illustrations, but the practical part. Question number 4. Let's see. It is again on the levels of inventory. A company uses 3 raw materials A, B and C for a particular product for which the following data apply. So 3 raw materials are given, that is A, B and C. Usage per unit of the product is given, that to manufacture 1 unit of the finished product, how much of the raw material is required, that is 10, 4 and 6. Reorder quantity ROQ is given 10,000, 5,000 and 10,000. Price per kg is given to you. Okay. Delivery period in the weeks is given, that is your lead time is given to you. Then reorder level is given for A and B, not for C. And the minimum level is given for C and not for A and B. After that, they say the weekly production varies from 175 to 225 units, averaging 200 units of the said product. Right? The weekly production varies from 175 to 225, averaging 200. Compute the following. Minimum stock of A is what we have to calculate. Minimum stock of A. What will be the minimum level of A? Minimum level is ROL minus average consumption into average lead time, right? So what is the reorder level? Reorder level for A is already given to you, 8,000 minus. Now what will be the average consumption? Here we can commit a mistake. Now this is the part where you can commit a mistake. What? You can take the average consumption as 200 units and multiply it with the lead time. That is 2 given, average lead time. Right? You might write it as 200 units into 2. But one thing you have to be careful here, sir. What is careful? What is the word used here? The word used here is weekly production. That means this data is about what? This data is about finished goods, not raw material. This 200 is what? It is not the consumption of raw material. It is the finished goods that they are talking about. So how we will calculate the average consumption of raw material? That will be 200 units multiplied by 10. That is, to manufacture 1 unit, how much of the raw material will be used, multiplied with 2. Right? This will give you, see here, average rate of consumption, ROL, minus average rate of consumption into average. What is the average rate of consumption? That is 200 is the average production of finished goods. To manufacture 1 unit, you need 10 units. Right? This is the important point of this question. After that, maximum stock level of B you will be able to calculate, that is ROL plus ROQ. For maximum we use minimum, that is minimum consumption into minimum lead time. Right? So what is ROL given? ROL is given to you, that is 4750. ROQ is given 5000 minus minimum consumption will be 175 into 4. Minimum lead time is given as 3. Right? So this is what they have done here, 175 into 4 into 3. This you will get it as maximum stock of B. Another important point that you have to be careful here is that for which raw material they are asking. They are asking for B and you are calculating for C, or you are calculating for A. Another very common mistake. So be very careful, read the question very carefully, which particular raw material they are asking for. Right? Next they are asking for is reorder level of C. Reorder level will be what? Maximum consumption into maximum lead time. Right? Maximum consumption into maximum lead time. What is the maximum consumption? It is the maximum production into 6 into lead time is 4. Now they are asking for C. This is what they have done here. Maximum delivery period 4 into 25 into 6. Or it can be minimum level of C. This will serve as your safety stock. Remember the another formula that we have used, that is safety stock plus average consumption into average lead time. This also can be used. The formula here that we have done for ROL, this safety stock, they can also consider it as the minimum stock level. This is the alternative one. Clear? Next is what? The average stock level of A. Average stock level of A. Now, how do you calculate the average stock level? One of the formulas that we can use is minimum level plus maximum level divided by 2. This is one formula that we can use. Another formula that we can use is minimum level plus half of ROQ. Now, if you want to use this first formula, that is minimum plus maximum divided by divided by 2, right? The minimum stock you have calculated in the first part, but do you have the maximum stock of A? No, sir. The maximum stock you will have to calculate. Then you can apply this formula. The second formula, minimum level, you have already calculated in the first part. ROQ is directly given in the question. So by applying this formula, you can save time in the examination. Both the formulas will get different answers. Both the formulas are absolutely correct. Isn't it? Both the formulas are absolutely correct. No issues in that. The only thing is that this formula will save time in this particular question. For this question, minimum level you have calculated, but you will have to first calculate the maximum level and then apply this average level. So this is another learning that how to save time in the examination. If you see minimum level plus half of ROQ, minimum level already calculated in part of 1, ROQ already given to you this 10,000. So mark it as another important question from the examination point of view. Is this question clear, guys? Question number 4. Is it clear, everyone? Yes. Please let me know if it is clear. Yes. Rest of the people, is it clear? Okay, let's come to question number 5. Now, this is another important question where we have the discounts. This is another important question where we have the discounts part. EXE Limited has received an offer of quantity discounts on its order of materials as under. Price per ton is 1200 if the ordered quantity is less than 500. If the ordered quantity is up to 499, the price of the raw material per ton will be 1200 rupees per ton. After that, if the raw material quantity that is ordered is 500 and less than 1000, that is the order quantity is between 500 to 999. In that case, you will get some discount from the supplier. The price will be 1180 in that case. If the order quantity is 1000 or less than 2000, that is from 1000 to 1999. In that case, the price per ton will be 1160. Now, if it is 2000 or less than 3000, that is from 2000 to 2999. Right, it will be 1140. If it is 3000 more than equal to 3000, it will be 1120. Right, so this is what is given to us, the prices at the different levels of the quantity that you are ordering. Now they say the annual requirement for the material is 5000 tons. The ordering cost per order is 1200. This is the value of your O. This is A that is given to you. Then the stock holding cost is estimated at 20% of the material cost per annum. This is the value of C. 20% of purchase price. You are required to compute the most economical purchase level. Now, which one will be the most economical purchase level? For that, we have to calculate at the different quantities. That if the quantity ordered is less than 500, 499 if the quantity ordered, then what will be the total cost at that? If the quantity ordered is somewhere between 500 to 999, then what will be the total cost? 1000 to 1999, what will be the total cost, and so on. Right, this is what we have to see. Now, for simplification, what they have done is less than 500 means we will take 400 quantity. You can take any quantity up till 499. You can take 472, you can take 473, you can take 499, any quantity you can take. But for the simplification, what we are taking is, for simplification, we take 400. Next, 500 to 999 means we can take 500. Here we take 1000, here we take 2000, and here we take 3000. Right? Now, in this question, one thing that you have to be very, very careful with. In this case, if the quantity order is 500, now the price will be whether 1200 or 1180. What is the range? Be very careful with the range that is given. Okay. So this is where you have to be very, very careful. What is the range that they are giving to you? Okay, let's see. So at the different levels they have calculated. See here, the total annual requirement is 5,000 tons. Now different order sizes they have taken. Order size 400, then what will be the total cost? If the order size is 500, then what will be the total cost? If it is 1,000, what will be the total cost? 2,000 cost, 3,000 cost. Right? So first thing they have calculated is number of orders. Number of orders means A divided by Q, right? Total annual requirement divided by the order size. See, in the first case, you are getting 12.5. Remember yesterday I told you regarding the orders that if you are getting the orders in decimal, what you should be doing? You should normally be doing the upper round off. That is why they have taken both the options 12.5, or you can take it as 13. Normally do the upper round off, right? Because you will place the full order, no? Isn't it? So what will be the inventory cost? Now, if you are placing an order for less than 500, what is the cost that you will have to pay? 1,200. So what will be the total inventory cost? Means the purchase cost, annual purchase cost. Units to be purchased is 5,000. What is the price that will be charged? That is 1,200. Then what will be the carrying cost? Ordering cost. Number of orders you have calculated. What is the ordering cost per order given? The ordering cost per order is given as 1,200. So number of orders multiplied by 1,200. Clear? Then carrying cost. Carrying cost will be average inventory. Now what is the average inventory? Means EOQ, or ordering quantity divided by 2. What is the ordering quantity here? 400 divided by 2 multiplied by carrying cost is what? 20% of what? Purchase price, that is 1,200. This will be your carrying cost. So be very careful while calculating the carrying cost. Right? So total cost will be what? Purchase cost 4 plus ordering plus carrying cost. In the second case, now if you are ordering 500 units, what will happen? Your number of orders will be 10. That is annual requirement 5,000 divided by 500 in one order. So 10 orders you will place. Yes sir, we will place 10 orders. What will be your purchase cost now? It will be 5,000 into 1180. Be very careful. Do not commit the mistake here. Do not take 1,200, because the question says if you order 500 or more than 500 up to 1,000, up to less than 1,000, what you will get? 1180 will be the price charged. Then ordering cost will be number of orders into 1,200, 10 into 1,200. How will you calculate the carrying cost now? The carrying cost, again you have to be very careful. Carrying cost will be what is the order quantity? 500 divided by 2. This will give you average inventory into 20%. 20% of what? 1180. So this will change. This will change. So carrying cost, you need to be very, very careful. It is not 20% of 1,200 every time. Here it will be 20% of 1180, sir. Is that clear? So you will calculate total cost. Similarly at 1,000, 2,000 and 3,000, you will calculate all the cost and then see where your cost is the least. Right? So your cost is the least at this level. That is when you are placing the order for 1,000 units. The above table shows that the total cost of 5,000 units including the ordering and carrying cost is minimum when the order size is 1,000 unit. Hence the most economical purchase level is 1,000 units. Right? So from here we calculate the economical purchase level. What is the second part of the question says? What will be your answer to the above question if there are no discounts offered and the price per ton is 1,500? So in that case EOQ will be simple, sir. 2 multiplied by what is the annual requirement? 5,000. Ordering cost 1,200. Carrying cost 20% of what? The price is 1,500. Simply you will calculate your EOQ. We'll see the answer. We'll do some cheating. Answer is 200 units. Right? No discounts. Now this is a very important question with regard to the discounts being offered. Go through the question and see if you have any doubts. We'll take up the doubts. This is these fourth question and the fifth question. These two are important from examination point of view, plus the example that this illustration that we have done. Right? So these are important from the perspective. Okay, let me know if you have any doubts in this. And all those who have joined, guys, please like the video. Hit the like button. And all those who will be watching afterwards also, guys, please do like the video. That will help in others identifying the video, get to know about the video. That's the only purpose, right? So it's a small help, small contribution from your side that you can do. Just like the video, and after the video, just give some good comments. Okay, any doubts, guys? Please let me know quickly if you have any doubts. Then we'll move on to the next part. All clear, everyone? So with this, we are done with the two very important topics, that is levels of inventory. Okay, so levels of inventory is done and EOQ is done. Let's come to our next topic, that is ITR. That is your inventory turnover ratio. Next topic that we have is inventory turnover ratio. Now, inventory turnover ratio topic says what? This topic is that how quickly you are converting your raw material into finished goods. Simple words, if I say that how quickly raw material is converted into finished goods. Sir, why it is important to know that how quickly we are converting our raw material into finished goods? It is important to know that. Why? Because there is a certain amount which is invested in the raw material. So till the time we are not converting that raw material into finished goods and selling those goods, we will not be able to recover that investment in the raw material. So the faster we convert our raw material into finished goods, the quicker we will be able to recover the investment in the raw material. That is why the business wants to know that how quickly you are converting your raw material, how quickly you are recovering your investment which is there in the raw material by converting it into finished goods and by selling that product. That is the purpose. Clear? So ITR is calculated as cost of raw material consumed divided by average raw material quantity. How, sir? I'm saying that on an average in my store, the raw material quantity, that is 1 lakh. Right? And if I look at the whole period, a particular period, it can be year, it can be a quarter, it can be the semi-annual. I say the total raw material I have consumed is 10 lakh. So ITR tells me what? The ITR tells me that how many times you have converted this 1 lakh of raw material, which is on an average in your store. How many times you have converted this 1 lakh into consumption, so that this total consumption is 10 lakhs. So 10 times you are converting it. Clear? So cost of raw material consumed divided by the average raw material quantity. Cost of raw material consumption, if the information is not directly available, it is opening stock plus purchases minus closing stock. Opening I'm having, I purchased more, my closing stock is something, the remaining will be the raw material consumed. And average is opening plus closing divided by 2. Right? So this is your inventory turnover ratio. Then the inventory holding period. What is inventory holding period? The inventory holding period tells us that for how long raw material is held in store. Raw material is held in store. Right? For how many days? We are saying that if in a particular year, if in a particular year you are converting your raw material 10 times, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times if you are converting, what is this number of days that you are holding? Right? So we are saying 10 times we are converting in 365 days or 360 days or 12 months. So this one conversion is after how many days? Divided by 10. This 10 is what? This 10 is your ITR. So 365 days or 12 months, or it can be 360 days also. Right? You can take 360 days also divided by ITR. That will give you the inventory holding period. For how many days you are holding the inventory in your store. Now, with regard to the number of days, whether we should take 365 or whether we should be taking 360 days, very simple logic. If the question specifically mentions that you have to take 360 days or you have to take 365 days, you will take those number of days. If the question is absolutely silent, then you can take any number of days. 99.9% of the times they will mention that whether you have to take 360 days or you have to take 365 days. 99% of the times they will mention. Clear? So this is your concept of ITR. Now this inventory turnover ratio, this is important for MCQ. This is important for MCQ. So this illustrations on this, you can do it on your own. I will not touch this part because it's a very, very easy part, right? So you can take it up. Is this clear? Any doubts in inventory turnover ratio? Meaning is clear for inventory turnover ratio? Yes, quickly let me know. Any doubts if you have in ITR? Now this ITR is not your income tax return. I know it's a ITR season going on, but this ITR is regarding the raw material. Yes, let me know guys if you have any doubts quickly. Clear? See, the meaning should be clear. Once the meaning is clear, you can solve any questions. And this inventory turnover ratio, institute is asking the MCQ on this. They can ask the MCQ on this again. Okay, so next, now on this inventory turnover ratio, sometimes they will ask you that whether the item is fast moving or slow moving. There is one theory topic that you can see that is called as FSN analysis. That is FSN. F stands for the fast moving raw material. Fast moving material. Right? S stands for slow moving material. N stands for non-moving material. Right? So FSN analysis is also there. It's a small theory concept, FSN analysis, based on the inventory turnover ratio. And what we are saying is, what we say, higher the ITR, better it is. We say higher the ITR or inventory turnover ratio, better it is. Why it is better? Because the higher ITR means that we are quickly converting a raw material. It means that quickly we are able to recover the investment that is there in the raw material, right? Quickly we convert the raw material into finished goods. We sell the finished goods. We recover the investment that is done in the raw material. That is why we say higher the ITR, better it is. Now coming to the next topic, this ABC analysis. This is mainly a theory topic. This is mainly a theory topic, but once in the exam, the practical is also asked on this. Once in the exam, the practical is also asked on this. 5 marks practical question, very simple, straightforward question was there. So what is this ABC analysis? It is basically the categorization of the different items lying in your store, right? What is ABC analysis? It is the categorization of the different items which are lying in your store. A category items are what? A category items are, what are A category items, sir? A category items are high value items, right? Which are the costly items. Items like 1 lakh, 2 lakh rupees worth of item, 5 lakh rupees worth of item, machinery is there, some important part is there. So high value items. These items are less in quantity. So if it is a high value item, so more control will be required. That is, more check will be required that there is no theft with regard to that particular item. So it is a high control required. Category B items, these are the medium value items, medium in quantity, medium control required. Category C, low value items, right? Small nut bolts are there, small parts which is costing 1 rupee, 2 rupee hardly. High in quantity, low control required. Now, one thing that you have to remember, this categorization, whether this categorization is to be done on the basis of value or whether it is to be done on the basis of quantity. Why more controlled is required? Because of the high value or because of the quantity? Sir, it is because of the value. So whenever there is ABC analysis, it will be done. ABC analysis is to be done on the basis of value. So what we say, categorization is to be done on the basis of value and not quantity, right? This thing you have to remember. If there are 10 items given to you, how will you categorize between A, B and C? You will categorize on the basis of value. And this categorization criteria will be given in the question. They will tell you that, okay, if the item value is more than 50,000, it is a A category item. If the item value is between 20,000 to 50,000, it will be a B category item. And if the item value is less than 20,000, it will be a C category item. So this categorization will be given to you in the question itself, right? So this is your ABC analysis. On this, if you see, just do one illustration number 8. Right, illustration number 8 is there where they have given items, 12 items are given, number of units are given and unit cost is given. So can you directly categorize? No sir. What will you do? You will first calculate the total cost here, total value, that is units into unit cost, units into unit cost, unit into unit cost, unit into unit cost. Then you will do the ranking. Then you will do the ranking part after calculating the total cost. Right? So you have to be very, very careful with this part. Total cost and then ranking. This base in the solution that they have taken, that if the value of the item is 50,000 and above, it's a A item. If the value of that item is 15,000 to 50,000, it's a B category item. If it is below 50,000, it's a C category item. This will be given in the question. This will definitely be given to you in the question. The reason being, if this is not given in the question, then what will happen? It will be very difficult for the institute to create the suggested answers. If they keep it open, one student will select 50,000 and above, another student will select 40,000 and above A category, another will select 35,000 and above A category, right? Then institute will not be able to make the suggested answers. So this categorization, how to categorize, it will be given in the exam. Is that clear, everyone? ABC is clear. Now this is a very important topic. This is important, sir. ABC is important for theory also. Short note also they can ask on the ABC. Please quickly let me know if it is clear. Everyone clear with this? Okay, so let's move to the next topic. a last one, that is valuation of inventory issue and the closing stock of inventory. How to value it? Valuation of inventory issue and the closing stock of inventory. Now in this there are many methods. There are various methods which are there. The methods like cost price methods are there, then average price methods are there, then market price methods are there, but I will discuss 4 most important methods, right? 3 most important methods. The 4th one is very simple: first in first out, last in first out, and weighted average method. These are the 3 methods on which institute has been repeatedly asking the questions. These are the 3 methods on which you will find the questions in your module also, right? Although in the examination they are asking this part comparatively lesser than the inventory part and the EOQ part. Inventory levels and EOQ part they are asking more. ITR they are asking in the MCQ, right? This part they are asking comparatively less. Now, what is a first in first out method? The first in first out method says that if there is any material which is issued, material which is received first will be issued first. Let's say you are receiving the material on 5th of April, 100 units at rupees 10 per unit. Then again you are receiving it on 10th of 4, 100 units at the rate of 12 per unit. On 15th of 4, if you are going to issue 50 units, which one will you issue? You will issue the first one. The material which is received first in the store will be issued first. So material received first in the store is issued first for production, useful during the falling prices of raw material, right? If the prices are falling, it is good that you value it on the higher side. If you value it on the higher side, right? If you value your issues, you can take more expenditure. More expenditure means lower profits. Lower profit means lower taxes, right? So that is why it is more useful during falling prices. If your prices are falling, that here you are receiving, instead of 12, you are receiving it for, let's say, 7 rupees. So value it at 10 rupees. Issue, if you value the issue at 10 rupees, then what will happen? That means you are taking more expenditure. More expenditure means lower profit. Lower profits means lower taxes, right? Last in first out. The last in first out method says that whatever the material is received last in the store will be issued first. That is your last in first out method. Material received last in the store is issued first for production, useful during the rising prices of raw material. Clear, sir? And this last in first out method is more appropriate than the FIFO method. Why? Because it reflects the near market price values, right? It is better than, what we say, it is better than FIFO method. Why, sir? If they ask you whether LIFO method is better or FIFO method is better, so we can say this LIFO method is better than the FIFO method. Why? Because it reflects near market prices, near market price values, right? That is why this method is better than FIFO method, right? Now in this LIFO method, when we are saying the material received last is issued first, one thing you have to be careful. They say this is the time period, this is 1 month. On 1st of April, you received 100 units at rupees 10 per unit, right? Then again on 20th of April, you received 100 units at rupees 12 per unit. On 30th of April, you received 100 units at rupees 15 per unit. Clear? Now they say during the month of April, your issue is what? You issued issued 150 units between 1st of April to 29th of April. Now, as per LIFO method, you will say that, sir, material received last should be issued first. So can we issue this material of 30th of April? When we are talking about this 150 units, can we issue the material which is received on 30th of April in this case? Please let me know. Can we do this? Can we do this, guys? For this 150 units, can we issue 30th of 4th material? No. We cannot issue this. We cannot issue this, sir. Why? Because the issue is taking place between 1st of April to 29th of April. So the material received on the last day is not issued in this period. No. Right? So in this case, you will start with this value. You will issue 100 units at the rate of 12 and you will issue 50 units at the rate of rupees 10. Is that clear, everyone? Right, so this is one point you have to be careful in case of LIFO method. Right? Then next we have is weighted average method. The weighted average method says the material issue may be according to FIFO or LIFO. That is fine, but the valuation is to be done at the weighted average rate. Useful when the prices fluctuate considerably and the quantities are also not in uniform. One time you are ordering 10 units, you are getting it at 10 rupees. Another time you are ordering 50 units, you are getting it at 20 rupees. Another time you are ordering 100 units, you are getting it at 15 rupees. So in that case, what we will do is we do the weighted average thing, right? In that case, what we do is weighted average thing. So weighted average, how the weighted average rate is being calculated, sir? How the weighted average rate will be calculated? It is quantity 1 into rate 1 plus quantity 2 into rate 2 divided by quantity 1 plus quantity 2. This will give you weighted average rate. Quantity 1 into rate 1 plus quantity 2 into rate 2 divided by quantity 1 plus quantity 2. This will give you weighted average rate. Is this clear? So this will give you, and this quantity is what? The quantity, which quantity is to be taken? This quantities will be quantity in stock. This will be quantity in stock. Right? Now, what is the journal format for stock ledger? This we have to see. What is the journal format? There is no hard and fast rule although, but normally what is the format being followed? The format being followed is date. First we'll write down the date. Then we will write down all the receipts. In the receipts column, we will take up three things, that is quantity, at what rate it is being received, and we will take up amount. Then we will take the issues column. In the issue also you will take quantity, rate and amount. Then we will write balance. Balance, quantity, rate and amount. Right, this is the journal format that we follow. This is the journal format that we follow for stores ledger. Now, clear? Some few important points. If it is a return to supplier, if an item is returned to supplier, then the issue will be at the rate at which it was purchased, then the weighted average rate will not be applicable, then FIFO-LIFO rate will not be applicable. If you purchased 100 units from the supplier, out of those 100 units, 10 units were defective, right? So you are returning those 10 units to the supplier. The valuation of those 10 units is to be done at the purchase rate, not at the weighted average or LIFO-FIFO rate. Then return from production to store. From the production area back to the store, receipt at the rate at which the specific issue rate if available, or the last issue rate. If they are mentioning that, okay, this was the return is from the material which was issued on 10th of April, then the rate at which you have issued, you will get back it. If it is not mentioned that it is out of which issue, then you will have to take the last issue rate. Another important thing, shortages, abnormal shortage to be taken to costing P&L account. In the stores ledger, write in the issues column, will write quantity rate amount, take it to costing P&L. If it is a normal shortage to be absorbed by good units, in the stores ledger, write only the quantity in the issues. So here we will just write down, the quantity, will not write down the rate, will not write down amount. So what will happen? Whatever are the good units there, right? This rate for the good units will increase, because what we say, yesterday only I told you the normal loss is to be borne by good units, right? The normal loss is to be borne by good units. Another important point in this, in the stores ledger, we will record only those transactions which involve the inflow or outflow of material from the store. If there is a material being transferred from one job to another job, it will not be recorded in the stores ledger, right? So write down in stores ledger, we will record inflow and outflow of material from store. So if there is a transfer of material from one place, from one job to another job, it will not be recorded. This is very, very careful. Okay, so with this I have covered almost all the major concepts here. One small concept, theory concept, again I'll discuss, that is your just-in-time inventory. What is just-in-time inventory? Another important concept here. This is only theory, important for theory purpose, right? What is just-in-time inventory? That we will not keep the stock. We will not keep the stock. We will order raw material when required. Order raw material when required. No stock carried. So in this case, what is the biggest benefit? The biggest benefit is that your carrying cost will be negligible. Right? This is the concept of just-in-time inventory. As and when you need the inventory for production, you will order that inventory. You will get the inventory directly into your store and into your production area. No need to carry the inventory in the store for 10 days, 20 days, 30 days before the production. Right? This is the concept of just-in-time inventory. So with this, the concepts are over for material costing. Okay, any doubts in the last concept? If you have, then I will move to this particular question which is there. Which question, sir? We will do question number 8. Right? We'll do question number 8. Right? Right, sir. We'll do this question number 8. Okay, first let me know if you have any doubts in this. First, let me know if you have any doubts. I'll take up the doubt. Then we will do this question number 8 and wind up this chapter on material costing. Okay, I'll wait for 2 minutes. So if you can tell me if you have any doubts. Then before the break, we will wind up this chapter. Then after break, we'll start with labor costing. No doubt, everyone, rest of the people who are there, everyone is clear with this? Now just do one thing, take a 2 minutes breather, right? In the 2 minutes, revise all the concepts that we have done once. Just 2 minutes breather I'm giving you, right? Take a 2 minutes short break. Revise everything regarding the material costing. Then I'll take up question number 8. Practical question number 8 we will take up. 2 minutes I'm giving you quickly. After 2 minutes we'll start with this question number 8. If you have any doubts, you can drop in your doubts. Okay, let's start with this problem 8 and wind up this chapter on material costing. Let's do it. Okay, let's start with this problem 8 now. Problem 8. AT Limited furnishes the following store transactions for September 2022. On 1st of April, the opening balance is given to you 25 units valued at 162.50. Now, here you have to be very, very careful. What is given? You have 25 units. You will write the balance on 1st of April, 25 units written in the quantity. But this what is given, this 162.50, is it rate or is it amount? See what is given. They say valued 162.5. So this is not rate. This is the total value of the 25 units. So in the value column, they have written 162.5. So what is the rate here? The rate here is 6.5 rupees. You have to be very careful with the language of the question. So this is one point where you people can commit mistakes. whether it is the rate per unit given or whether it is the total value which is given to you. Right? So opening balance we will record on 1st of April. Directly in the balance column we will record this opening balance. Then on 4th of September issue requisition number 85, 8 units are issued. Okay, this is to be done on what? Stores ledger is to be prepared on the FIFO method and state how will you treat the shortage in the stock taking. On FIFO method we are doing it. Issue 8 units. So you will record it in the 8 units. You will record against a requisition number 85. So this is additional column that you can prepare or you can skip also. This requisition number column you can skip also, guys. No issues in that. Okay. So 8 units you are issuing. At what rate you will issue? This 6.5 you will issue. 52. The balance is out of 25. 8 units issued. 17 is the balance at 6.5. Done with that. Then 6th of September, receipts from B and Company, 50 units at 5.75. Right? You have received a material. You have received a material from B and Company. You received 50 units at 5.75. So we will record here 50 units received at 5.75, 287.5. Now when you are doing by FIFO and LIFO method, you have to show the stock separately. First, you will write the old stock, the received first 17 units. The old one we are having at 6.5. Another stock we are having is 50 into 5.75. Total value of the stock is 398. Is that clear? Total value of the stock that we are having is 398. So this was a simple transaction. On 7th of September, you will issue 12 units. So you will utilize this first because first in, first out. These 17 units were first received in the store. So you will issue these 17 units. Out of this, you will issue 12 units at 6.5. The remaining is 5 units at 6.5 and then 50 at 5.75. Total value 320. Simple question, sir. In this also there should not be any problem. Then on 10th of 9, return to B and Company 10 units. Now be very careful here. From the B and Company, what we have received, from B and Company we have received 50 units. Out of that 50 units, 10 units you are saying were defective. So we are returning those 10 units. At what value you will return? I told you that if it is a return to the supplier, in that case you will not see FIFO or LIFO method or weighted average method. In that case, the valuation is to be done at the rate at which it was received from the supplier. So the rate at which it was received is 5.75. So this will be valued at 5.75. And where will you record it? We will record it in the issue column. Right? Return 10 units at what rate? At 5.75. So what is the stock that you are having? The stock you are having is this 5 units as such you are having at 6.5. Then this out of this 50 units, 10 units you have returned. So you are left with 40 units at 5.75. Right? So this is the point that is given in the notes also. So this is one important transaction. Be very careful. Next one is issue acquisition number 15 units you are issuing. So 15 units is 5 units this and 10 from this 40. So what you are left with is 30 units at 5.75. Simple. 30 units you are left with. According to the FIFO method, you will keep on issuing. Okay, stock out illustration we'll take after this. Fine. Got it. Vedant, I'll take illustration number 7 after this. Right? I'll take it. Next we have is on 13th you again have issue of 20 units. So you are having a stock of 30. Out of that you will issue 20. You are left with 10. Fine, sir. You are left with 10. Next, 15th of September, receipts from M and Company 25 units at 6.10. So 15th of September received 25 units at 6.10. You are already having 10 units at 5.75. 25 more received at 6.10. So total value is 210. Then after that 17th issue acquisition number 10 units. So you will issue 10 units from where? This 10 units you will issue. right? The first stock, 10 units of first stock that you are having, you will issue, you are left with only 25 units at 6.10. This is M&D company stock. Next transaction, received the replacement from B&D company 10 units. So we have received 10 units. At what rate you will receive? Be very careful. You will receive it at the original rate, that is 5.75. So what you are having now is 25 units at 6.10 and 10 units at 5.75. Now this receipt here, sometimes the doubt will come that, sir, whether we can show 10 first and 25 later. No, sir. This receipt is to be considered as a fresh receipt. So these 25 units were received first. These 10 units you are receiving later. It is to be considered as a fresh receipt. Right? So if there is any kind of this confusion or this question in the mind, first you will take this as a fresh receipt only. After that, the next transaction, now comes this transaction. This is important transaction here. What they are saying is return from department. Read it very carefully. What they are saying is return from department. Department means what? From the production. Returned from production material of M&D company MRR 4 5 units. 5 units. Right? So this is returned back to the store. Returned back to store. Now what they have mentioned here is that it is the material of M&D company. The material of M&D company is received at the rate of 6.10. But if you look at the store's ledger, what is the quantity that you received from M&D company? 25. 25 units you received. Now my question is, have you issued anything out of this 25 units? Have you issued anything out of this 25 units? See here, 25 units are as such lying in the store itself. If you have not issued anything out of those 25 units, then how can you get it back from the production? So this is a technical problem. So if it is not issued, how can you get it back from the production? So what should be done, sir? What should be done? Sir, we will record this return at the last issue rate. We will record this return at the last issue rate. That is what I have mentioned in the notes also. Right? Return from the production to the store, receipt rate, specific issue rate if available, or the last issue rate. So in this case we will take what? In this case we'll take the last issue rate. That is what the institute has also taken. 5 units at 5.75. Now, sir, will this be recorded before 25? Yes. Yes. Because these were originally received in the store earlier than 25 units. These 5 units that you have issued, these were received in the store earlier than 25 units. So next time you issue, you will first utilize these 5 units. Right? This is important point. Now this is not a fresh receipt. It is originally receipt was before 25 units. You issued to the production department returned it. They say, sir, it is excess unit. We don't need it right now. But the next time when you will issue these old 5 units first. Then you will issue the 25 units. Right? So this is now the stock that you are having. This is an important transaction here. Next one, 22nd of September, transfer from job 182 to 187, nothing to be done. As I told you that in the store's ledger, we will be recording only those transactions where the store is involved. Job to job transfer, ignore, sir. Issue requisition number, this 10 units, okay, 5 you will issue from here, 5 from here and 5 from here. 10 units you will issue as per FIFO method. No issues. Transfer from department A to department B, nothing to be done. No entry because the store is not involved here. Shortage in stock taking 2 units. Now it depends what you are considering this shortage as. What they have done is 2 unit shortage they have taken. right? And they have taken it from the last stock, which is there 6.10, from the first stock that is there. So remaining 18 units at 6.1 and 10 units at 5.75. Clear? So what they have done here is they have assumed the shortage to be abnormal. They have assumed the shortage to be abnormal, right? Had it been, now listen to it very carefully, had it been a normal shortage, in that case, how will you treat? In the case of normal shortage, here you will write 2. You will not write anything here. You will not write anything here, right? So here you will have 18 units, but what will be the value? The value will be 20 into 6.10. The value will be 122. Only for this part I'm saying. So 122 divided by 18, it will come to 6.78. What is the rate here? 6.10. Here your per unit rate will inflate. It will increase. So if it is a normal loss, this is how you will treat. This 10 units will remain same. Right? So in this 20th transaction is important. So we are done with all the transactions, and one return to B and company, returned transfer from this, received replacement. This is important. This is to be done very carefully. What is there? Is this question clear, guys? Any doubts in question number 8? See, the small points will be there which you have to be careful about. That is what I have to discuss here. Those small areas we have to discuss. Yes, let me know if you have any doubts in this. Okay, you're talking about illustration number 7, right? Let's see illustration number 7 after this. Yes, please quickly let me know if you have any doubts, guys. All clear? Okay, now coming to this illustration number 7. This illustration number 7 is on what? It is on inventory stock out. What is this inventory stock out? What is this concept of inventory stock out? Now, this concept of inventory stock out says that how much of the safety stock we should be keeping. How much safety stock should be kept. How much safety stock should be kept. Right? Because they say there are two costs. If you are not keeping any safety stock, there might be a situation of stock out. A customer comes to your shop, ask for a particular material, you're not having that particular material because you're not keeping any safety stock for that, right? The demand increase, the customer is coming to you, but you're not having the stock. In that case, what will happen? Your customer will go to your competitor. You will lose out on the customer. That is what we call it as a stock out cost. We call it as a stock out cost. Second, if you keep, next time what you are saying is, next time you are saying I will keep a lot of safety stock. No customer should return. In that case, if you are keeping a high safety stock, what will happen? In that case, your carrying cost will increase. So this stock out says what is the optimum safety stock that you should be keeping so that this total cost is minimum. Right? That how much of the safety stock we should be keeping so that our total cost is minimum. Is that clear, everyone? Right? So this is the basic concept. Now we'll come to this illustration number 7. This is on this. Messrs. Tyrotube trades in 4-wheeler tires and tubes. It stocks sufficient quantity of tires of almost every vehicle. In the year ending 2022-23, the report of the sales manager revealed that Messrs. Tyrotubes experienced stock out of the tires. Right? So there were situations when the customer came but there were no stock. The stock out data is as follows. Stock out of the tires, that 100, that means there was a demand of 100 tires, but there was no stock of 100 tires. But is it every time? No, sir. It happened out of 100 times, it happened only twice. Right? Out of 100 times, it happened only twice, that there was a demand of 100 units, but there was a stock out. There was no stock of 100 units. Next, there was a demand for 80 units, but there was a stock out. There were no tires in there. How many times it happened? Out of 100 times, only 5 times it happened, sir. Demand of 50, stock out, 10 times it happened. 20 times it happened. 10, 30 times it happened. No stock out, 33 times it happened. Right? Messrs. Tyrotube loses rupees 150 per unit due to the stock out. So this is your stock out cost. And it spends rupees 50 per unit on the carrying of inventory. So this is your carrying cost. Determine the optimum safety stock level. Whether we should be keeping a safety stock of 100 units, 80 units, 50, 20, 10 or no safety stock. How we will decide? That is what I told you. This will be decided on the basis of this cost. We will add the different safety stock levels, that if we are having a safety stock of 100 units, what is the total of my stock out cost and my carrying cost? This is what I have to calculate now. Okay, sir. Let's take the first scenario. The first scenario is if you keep 100 units as a safety stock. This is my first scenario. If you keep 100 units as a safety stock, and what I am saying is, I am saying there is a demand for 100 units. There is a demand for 100 units. Will there be a situation of stock out ever? You are having a safety of 100. There is a maximum demand of 100. Will there be a situation of stock out? Never, sir. Stock out units will be 0. Right? The probability, what is the probability that there will be a demand of 100? It is not 0.33, it is 0.02, sorry. Because out of 100, only 2 times it happened that there was a demand of 100. So stock out cost is 0. Expected stock out cost on the probability is 0. But what will be your carrying cost? You are carrying 100 units. And for every 1 unit, your carrying cost is rupees 50. So 100 into 50, 5,000 is your carrying cost. Total cost is what? Stock out cost is 0. Expected stock out cost is 0. Carrying cost is 5,000. So total cost is 5,000. This is the case when we are carrying a safety stock of 100 units. Clear? Second case. Let's take up the second case. We say if you are having a stock of 80 units, safety stock of 80 units. Now listen to it very carefully. If you are having a safety stock of 80 units, if there is a demand up to 80 units, will there be any issue? There will be no issue, sir. You are having a safety stock of 80, you are getting a demand of 80, you will be able to fulfill that demand. But if there is a demand of 100 units, then what will happen? In that case, you will be short by 20 units. In this case, you will have a stock out of 20 units, so 20 units stock out. But will it be every time? No, sir. It is only 2 times out of 100 times. So what is the probability of happening this? 0.02. What is the stock out cost? It is 20 into 150. For every 1 unit, they will be losing 150, no? So 3000. But they say 3000 is not going to happen every time, Nasor. There is a probability that it might happen. What is the probability? Only 2%, sir. Only 2% probability. So what is the expected stock out cost? Expected stock out cost is based on probability. If you take complete 3000, that means you are saying it will surely happen. But we are saying it will not surely happen. Isn't it? It depends upon the probability. So expected stock out cost is what? 3000. That if it happened into 0.02, it will only be 60. Then what will be the carrying cost? Now you will be carrying 80 into 50, 4000. So what will be your total cost? 60 plus 4000, that is 4060. Probability for 0 is 0.33. But what is the probability that you will get a demand? This stock out will be 0 only if demand is 100 units, right? Anyhow, it will not impact. Even if you take 0.33 or you take 0.02. In the earlier modules, it was taken 0.02. Then they changed it to 0.33. Right? However, it is not going to impact your solution in any case. Clear? Then the third case here is if you are keeping a safety stock of 50 units. If you are keeping a safety stock of 50 units, then what will happen, sir? Up to the demand up to a level of 50 units. No problem, sir. No problem. Absolutely no problem. But if the demand increases to 80 units, then there will be a stock out of 30 units. Or if the demand is 100 units, then there will be a stock out of 50 units. So it can be a case here what? The case here is either a stock out of 50 units or a stock out of 30 units. 50 units is if there is a demand for 100 units. 30 is if there is a demand for 80 units. What is the probability? 2% and 5%. So you will calculate the stock out cost, that is 50 into 150, and here it will be 30 into 150. Then based on probability expected stock out cost, that is 7500 into 0.02 and this into 0.05. Clear? Total 375 is the expected based on probability. Then what will be the carrying cost? You are carrying 50 units. For every unit, it is 50 rupees carrying cost. So 2500 total cost is sum total of this 2875. Is that clear? Fourth scenario, if you are keeping a safety stock of 20 units, then what will happen? Up to a demand of 20 units, there will be no problem. No problem up to a demand of 20 units. But if the demand is 50 units, then you will be 30 stock out. If there is a demand of 80 units, then you will be 60 stock out. And if there is a demand of 100 units, you will be 80 stock out. So what is the probability? 2%, 5% and 10%. So that is what is there. 80, 60 and 30, 2%, 5% and 10%. Stock out cost will be what? 80 into 150, correct. Right? It will be 60 into 150, it will be 30 into 150. Then the expected stock out cost into 0.02 into 0.05 and into 0.10. This will be your total expected stock out cost plus carrying cost will be 20 units into 50,000. So total cost is 2140. Next case that we have is if you have 10 units at safety stock, then there will be 4 scenarios. Up to a demand of 10 units, no issues. Up to a demand of 10 units, no issues. But if the demand is 20, 10 stock out here, 40 stock out here, 70 stock out, and here 90 stock out. Clear? Then you will take the probabilities. Last case is if it is 0, then everything is a stock out. Whatever the demand comes, it is a stock out. Then the carrying cost will be 0. So if you look at this, your cost is the least here. When you have 20 units as a safety stock, at that point of time, your expected stock out cost and your carrying cost is the least. Okay, any doubts in this question? Tell me if you have any doubts in this question. Yes, rest of the people, if you have any doubts in this question, please let me know. Although the stock out question, I don't think they have asked much on this stock out question. Right, but they can ask, definitely. You never know with the institute. Clear everyone? Rest of the people, Vedant, Shruti. So all these people who are online, please let me know if you are clear. So with this, we are done with material costing, right? Yes, okay. So we are done with the material costing part. So let's take a break of 20 minutes, right? We will resume after 20 minutes, have your dinner. I'll also have my dinner. Then we will start with the labor costing. So today we'll try to cover all the concepts of labor costing. Tomorrow we'll do the selected questions on labor costing, then complete labor costing and start with overhead costing, right? Okay, so let's take a break now. See you guys. It is 7:30. We'll start at 7:50. Right? So let's take a 20 minutes break. We'll resume in 20 minutes. Okay? Okay, I'll play the timer. I'll try and play the timer 20 minutes. Okay, so welcome back. Please let me know if you guys are live online. We are back. Okay, just let me know if you people are back. Quickly drop in a message, then we'll start with our next topic, that is labor costing. We'll start with labor costing. Yes, back. Good. Okay, so let's start with this. Now we will be starting with our next topic, that is labor costing. Another important chapter, the second element of the cost. So if you remember, yesterday we covered the elements of cost. In that, the first element that we covered was material. So based on that element, we have covered our material costing, right? After that, the second element that we are having is labor costing. Now in this chapter, what we will be talking about, we will consider only the direct labor cost. So basically, what is a labor cost? Labor cost is any payment being made, right, or to be made to the worker. Any payment which is paid or to be paid to an employee of the factory, that is a labor cost. Now this chapter will be studying from two perspectives. One is from the perspective of employer, right? For employer, it is a cost. Second, we have to study it from the perspective of employee. For employee, this is an income, right? For the employer, it is a cost. Cost is any payment being made, any payment made or to be paid, any amount paid or to be paid in cash or in kind. Even if you are giving a gift, even if you are giving a gift to the employee, it is a cost for the employer. So the employer has to consider it as a cost, right? So it has to be considered as a cost. Clear? From the employer perspective, it will be a cost. Now, if an employer wants to know what all is there in the labor cost, first, the basic pay that you are paying to the labor, to the worker, the basic pay, 10,000 rupees, 20,000, whatever is the basic pay. Then you will pay some dearness allowances, other allowances like HRA and all. House rent allowance can be there. Then some perquisites can be there, bonus, commission. Now this is very interesting. Employer's contribution to PF and ESI. What is this? Let's say there is an employee named Ram, right? Now the employer says what? Now this worker, he doesn't know about any investment or something. The employer says, listen Ram, what I will do is very simple. The employer says, I will pay you, your total salary is, wait, I'll take the total salary here. For Ram, the total salary is 12,000 rupees. Total salary is 12,000, not 10,000. 12,000 rupees is going to be the total salary. Ram is happy. Ram says, okay, sir, I'll take 12,000. But the employer says here that out of this 12,000, sorry, 10,000 I will give you in hand. And this 2000 rupees, I will do what? I will invest on your behalf. This is your investment on the behalf of employee. Right? So this 2000 which you are making an investment on the behalf of employee, this is again a cost for the employer. Right? This is a cost for the employer. Clear? So that is why we have added here what? The employer's contribution to PF and ESI. This is what is investment. Now I have written one more line here. I am saying the employee's contribution to PF ESI, but I have striked it out. Why? Now if you have given 10,000 and 2,000 to Ram, now while going back home, the Rams thinks, okay, I am having 10,000, but I don't need 10,000. What I will do is, out of this 10,000, 1,000 rupees, I will also invest in PF ESI, Provident Fund and ESI. Right? So is it adding to the cost for the employer? Is there any additional cost that the employer has to pay? No, sir. Employer has to pay only 10,000 and plus 2,000. This 1,000 is out of this 10,000 only. Right? Once you have given the money to the employee, whatever the employee is doing with that money, that is not the cost for the employer. Employee can take it home, employee can take 10,000 rupees home, or employee out of this 10,000 rupees, what employee can do is employee can invest some amount on his behalf in the PF and ESI. That is why I have striked it out. That is what I have done here is I have striked this employee's contribution. Right? Why I have striked it out? I am saying it is not a cost for employer. Not a cost for employer. Is that clear? So that will give you the labor cost. So what all will be included in the labor cost? Any payment which is being made by the employer. Any payment which is being paid by the employer. Now, one thing, there is an employee A. The employer says, you take the home, right? He is from an outstation. He comes to the city, joins the job. The employer says, do one thing. You take a house on rent, right? There is a house on rent. The rent is 12,000 rupees, right? The company will pay 12,000, but out of this 5,000 we will deduct from your salary. We will deduct from salary. Company will pay this 12,000, but out of the 12,000, 5,000 company will deduct from the salary. So what is actually the cost to the employer for this particular rent? The cost is 12,000 minus 5,000. Only 7,000 is the cost for the employer. Right? Another example, advance given to employee. 5,000 rupees, the advance is given to the employee. Now, is it a cost for the employer? Is it a cost for the employer? No, sir. It is not a cost for the employer, because when we did the basic definition of cost, what we were saying, the cost is any expense where the money flows out, right? But it will not come back. But in case of advance, this money will be returned by employee. This will be returned by employee. So this is not a cost for employer. Not a cost for employer. So you have to, if they ask you a question on this, that what all is included in the cost, labor cost for the employer, you have to be careful that what all expenses are being paid by the employer, where the money is not going to be returned to the employer by the employee. Right? Now, so this is the total labor cost. Now, if the employer, as an employer, I want to know what? As an employer, I want to know that what is the labor cost that I am paying per hour, right? Effective labor cost. Effective labor cost here means the effective labor cost per hour. For every 1 hour which the employee is working in my factory, what is the cost that I have to bear, right? So total labor cost I have calculated here, divided by the effective labor hours. Now see the word that I have used here. I have used here word effective labor hours. What do you mean by the effective labor hours? Effective labor hour means the number of hours for which the worker is involved in the manufacturing. Let's see. Now, there are two things. One, we call it as total labor hours, right? Total labor hours is what? A worker comes into the factory at 9 a.m. Right? Worker comes into the factory at 9 a.m. He leaves the factory at 6 p.m. Worker comes into the factory at 9 a.m. leaves at 6 p.m. So what do you think? Is the worker working continuously for this 9 hours? His total hours means the total 9 hours he is spending inside the factory. This 9 hours is my total hours. Now, what do you think? This worker is continuously working for 9 hours. Is it possible that a worker is working continuously for 9 hours? Sir, it is absolutely impossible for a worker to work continuously for 9 hours. He needs a break in between. He will have a break for lunchtime. He will have a break for tea and coffee. Isn't it? So, this total time has been divided into two parts. One is called as the effective labor hours. That is the actually productive hours. Another one is called as idle time. Idle time is what? The time for which the payment is being made but no production takes place. Now, if a worker is having some lunch, he is having some tea, coffee, he is having some rest, will you deduct the money for this part? Will you say, okay, you were having lunch, we will deduct the money? Absolutely no. So this is your idle time, the time for which the payment is being made but no production takes place. Clear? Now this idle time is further divided into two categories. One is called as normal idle time. One is called as normal idle time. Another one is called as abnormal idle time. What is a normal idle time? Normal idle time is the one which we know it will be there, like the time for having the lunch, time for having some rest between the jobs, time for having the tea and coffee by the worker. So this is an implied time. This we know it will be there. So this is what we call it as normal idle time. Now, what is abnormal idle time? Abnormal idle time is something which is not anticipated but happened. For example, machine breakdown. Abnormal idle time example can be machine breakdown, sir. Wait. So abnormal idle time example can be machine breakdown. Now, you were anticipating that the machine will break down. No, sir. But because of machine breakdown, the worker is sitting idle. The worker is sitting absolutely free. Right? Or it can be due to the defective planning. Defective planning means what? The worker doesn't know what job he has to do next. So it can be because of the defective planning also. So these are the reasons for abnormal idle time. Normal idle time is what? Having lunch, rest, tea, coffee, right? So this is your normal idle time. So effective hours is what? Now this abnormal idle time, if it is an abnormal idle time, the cost for this abnormal idle time, whatever is the labor cost for this abnormal idle time, will you charge it from your customer? No ways. You cannot charge it from your customer. Even if it is due to the defective planning, it was your problem. How can you charge it from your customer? You cannot charge it from your customer. It will be taken to where? It will be taken to costing P&L account. Yesterday also I told you that if there is any abnormal loss, that abnormal loss will always be taken to costing profit and loss account. What about the normal loss? The cost of the normal idle time will be absorbed by good units, therefore deducted while calculating the effective hours. So effective hours will be what? Total labor hours minus normal idle time. Right? This is the part that for this part we are going to recover cost from customers. Recover cost from customers. This abnormal idle time cost is not to be recovered from the customers. Clear? This much part is clear. So effective labor cost per hour will be what? The effective labor cost per hour will be total labor cost divided by effective labor hours. Okay, so first let me know if this much part is clear to you people. Please let me know if this much part is clear, guys. The idle time part is clear, everyone? Yes. Okay, very good. So this is how we can find out that what is the labor cost which the employer has to bear, right? So it will be total labor cost divided by effective labor hours. Right? Now coming to the overtime part. Now coming to the overtime wages. Now what about the overtime? What about the overtime? Now if the worker, let's say your factory's normal hours are what? Your factory's normal hours are let's say 9 a.m. to 6 p.m. 9 a.m. to 6 p.m. This is what? This is the normal working hours. Normal working hours. And during this normal working hours, whatever is the rate that you are paying to the worker, whatever is the rate that you are paying to the worker, we call it as what? We call it as the normal, we call it as normal wage rate. Right? Let's say it is rupees 100. Let's say it is rupees 100. Now, if your worker works for beyond 6 p.m., if your worker works beyond 6 p.m., this is after that we call it as, let's say he is working till 9 p.m. This 3 hours extra, this 3 hours extra is what we call it as overtime. Now this worker will say that, sir, for this overtime, will he be satisfied with the 100 rupees? No. He will ask for extra money. He will ask for extra money for these 3 hours. He will be expecting more than 100 rupees. 100 rupees is the normal wage rate that is earning during the normal time also. So if he is doing some extra effort, for that extra effort, for those extra hours, he will be asking for some reward. Isn't it? For that extra effort, he will be asking for some reward. So overtime wages is per what? The wages paid for hours worked beyond the normal working hours. Overtime wages are paid according to either. Now, how the wages are being paid, what extra that he can expect beyond this 100 rupees, what extra he can expect now, it is determined either by the Factories Act 1948 or by the mutual agreement between the employer and employee. If any factory, any business is not being governed by the Factories Act, then it can be by the mutual agreement between employer and employee, right? Now, what the Factories Act says, listen to it very carefully. The Factories Act says that the overtime is to be paid at double the normal wage rate if a worker works for more than 9 hours in a day or 48 hours in a week. Right? First and the foremost thing is, you will pay at what rate? You will pay at 100 into 2. That is double wage rate. This is your double wage rate that you will pay. Double wage rate. But when will you pay this double amount? There is a condition for that. The condition says if the worker is working for, there are two conditions. One is 9 hours in a day or 48 hours in a week. If any one of the conditions is satisfied, 48 hours in a week. So what we are saying is, if any one of these conditions get satisfied, the worker is entitled to get an overtime at what rate? At double the normal wage rate. Right? This is what the Factories Act 1948 says. Now, the interesting part is what I have highlighted here, that this or condition might be given as and condition in the exam. So be careful. In the exam, they might say that the worker will get the overtime if he is working for more than 9 hours in a day and 48 hours in a week. Right? So what we are saying is, both the conditions should be satisfied. Right? What we are saying is that both the conditions should be satisfied. If any one of the conditions is not getting satisfied, if he is working for 9 hours in a particular day, but he is working for less than 48 hours in a week, then he is not entitled to overtime. He is working for more than 48 hours, but not 9 hours in a day, more than 9 hours in a day, then again he is not entitled to overtime. Clear? Is this much part clear, that what is overtime? How the overtime is being treated according to Factories Act 1948 or by the mutual agreement between the employer and employee is simple, that whatever the rate they decide, it will be according to that particular rate only. No problems in that. Is this much part clear? Yes, this much part is clear, everyone? Okay. Okay, one thing, all those who are live and all those who will be watching the video afterwards, guys, you can drop in the Google reviews or the ratings, right? The link I have put it in the pinned chat, right? In the pinned comments, I have put in the this Google review. You can do it after the class also. I'll put it in the pinned comments also, right? So you can do it after the class. At the end of the class, you can do it. Now, what will be the treatment of overtime wages in the costing. First thing is, we have decided that what will be the amount of overtime. It will be double the wage rate. How to record it in the costing? To record it in the costing, what we have to see the reason for overtime. What is the reason for the overtime? Accordingly, we can do the treatment. The treatment of overtime wages depends upon the reason for overtime, that why you have done the overtime. So it is the reason for overtime. Right? Reason number one says, if the overtime is at the request of a particular customer, right? I come to you, you are a manufacturer, I come to you and say that, sir, I need 500 pieces, but I need it urgently. I need it within the next 10 days. Please do the overtime. Whatever the extra charges for overtime will be there, I'll pay. Right? So if it is at the request of the particular customer, can you charge the overtime cost from all the customers, or will you charge it from that particular customer only? Sir, in this case, you will charge the overtime cost from that particular customer only. So what we are saying is, the whole of overtime cost will be charged to that particular customer. You cannot charge it from all the customers. It will be from that particular customer only. Clear? So this is the first reason. Reason number two, if the overtime is due to the general work pressure. Generally, the work pressure is there throughout the year. You have to do the overtime. Your product is so good. The demand for the product is so high that you have to do the overtime. Then in that case, the overtime cost will be charged from all customers using the inflated rate. From all customers you will be charging by using the inflated rate. Inflated rate means, earlier how we have calculated the labor cost per hour, we say total labor cost divided by effective hours. In that, now I will add my overtime cost also. Earlier what I'm saying is, under the normal circumstances, my labor cost is 10,000 for 1000 hours. So I will say rupees 10 per hour I will charge it from my customer. Right? This I will charge from all customers. Charge from all customers. This is what I will do. Yes, sir. Now in case of overtime, what I will do? In case of overtime, I will say 10,000 is the wages paid for the normal time, plus 5,000 I'm paying for what? 5,000 I'm paying as overtime, divided by 1000 hours of normal time plus 500 hours of overtime. So total cost of 15,000 being paid for 1500 hours. Right? So I think this will again come to 10 only, but it will be something different. Wait, inflated rate. It doesn't come out to be inflated rate. Let's say the overtime is only 200 hours. Right? Overtime is only 200 hours. So 15,000 you are paying for 1200 hours. So that will come to rupees 12.5. This is what we call it as inflated wage rate. Inflated wage rate. Right? This is what we call it as inflated wage rate. That is the normal cost plus the overtime cost divided by normal time plus overtime. This is what we call it as inflated wage rate. It is if it is due to the general work pressure throughout the year. Right? If it is general work pressure throughout the year. Right? So overtime will be charged from all customers using inflated rate. This is our second reason. Let's come to the third reason. Third reason is overtime to meet shortfalls in a production. If at any particular point of time you feel that your production is getting short, you will not be able to complete the order in time, In that case, you are getting the overtime done to meet any specific shortfalls, or you think there is an order in between, there is a festival season, right? So for a specific time only, not throughout the year, for a specific time only to complete that order, you have to get the overtime done. For multiple orders, not particular order I'm saying, for the multiple orders, you are getting the overtime done, right? In that case, what you will do is, whatever the normal wages that you are paying, the normal wages will be treated as the direct wages cost, and the overtime wages will be treated as overheads. Ultimately, it will be charged from all customers. It will be charged from all customers, right? It will be charged from all customers. The only difference is the treatment of the normal wages will be direct wage cost and overtime will be the overheads. Last is if the overtime is due to the mismanagement or any abnormal reason. So the whole of overtime wage cost will be taken to costing profit and loss account. So everything will be taken to costing profit and loss account. Simple. Is this clear? The 4 reasons are clear? Okay, please let me know if all the 4 reasons are clear for the treatment. If it is at the request of a particular customer, charge it from that customer. If it is the routine feature of the business, then the inflated wage rate will be calculated and it will be charged from all the customers. If it is to meet any shortfall in the production, then the normal wages will be direct wages and overtime will be overheads. If it is due to mismanagement, then costing P&L, sir. Yes, please let me know if all this overtime part is clear. So today we'll try and cover all the concepts of labor costing. Tomorrow we'll do all the questions of labor costing. Right, we'll try to finish it off the labor costing tomorrow first half. In the first 1.5 hours, we'll try to cover the questions and finish labor costing, then start with overheads. Okay, clear, done. Let's move to the next part then. One second. Okay, let's come to the next part. Now, incentive schemes. Now comes the incentive schemes. Now, what is this incentive schemes? And systems of wage payment. There is one topic, these are interrelated only. There is a topic called systems of wage payment. Right? Systems of wage payment. It says how you are going to pay to your worker, right? Depending upon the number of units you will pay or depending upon the number of hours you will pay. How you are going to pay to your worker, incentive schemes or the systems of wage payment. In that, the first system that we have is time rate system. That we have is time rate system. What is a time rate system? The time rate says we will pay to the worker according to the number of hours that the worker is spending. So we will fix a rate for per hour. We'll say worker, your rate per hour is rupees 100. Right? So worker says, okay sir, if I take, so time taken, if the worker is working for 5 hours, right? On a particular piece, on a particular job, if a worker is working for 5 hours, so what is the wages that we will pay to that worker? The wages paid will be 5 hours multiplied by rupees 100 per hour, right? So we'll pay rupees 500. This is one of the systems, that is time rate system, right? Systems of wage payment, that is the payment of the wages on the basis of the time spent by the worker. Second system that we have is piece rate system. Second is piece rate system. Second we have is piece rate system. Now, what is this piece rate system? That the payment of the wages will be dependent upon the number of the units being manufactured by the worker, right? For example, what we are saying to the worker, that worker, your piece rate is rupees 100, not the hourly rate. Your piece rate is rupees 100, that for every 1 unit that you are going to manufacture, we will pay you 100 rupees. The worker says, okay sir, I have manufactured number of units manufactured. The worker says, I have manufactured 100 units, sir. So what will be the wages that will be paid? 100 units manufactured. What is the rate per unit? The rate per unit is 100. So we'll pay that worker 10,000 rupees. Right? So we will pay to that worker rupees 10,000. This is what we call it as piece rate. Now in case of piece rate, there is one interesting twist that the ICI can do. In case of piece rate, I am saying there is one interesting twist that the ICI can do where you have to be very careful. What is that interesting twist? See here, this interesting twist, I will mark it as like this. What is the information they will say? They will say the wages to be calculated on the piece rate. Listen to it very carefully what I am saying. I am saying the wages to be calculated on the basis of the piece rate. But what is the information given? Information given is hourly rate. Sir, hourly rate given? Yes, hourly rate rupees 100. Number of units manufactured. Number of units manufactured is 10 units. Now calculate piece rate. How will you calculate piece rate in this case? Sir, not possible, sir. Don't joke. In this case, one more information will be given to you. One more information will be given. That information will be time taken. They will give you the information on time taken to manufacture. Time taken to manufacture 1 unit is 2 hours. This is the additional information that they will give. Now we can calculate the wages on the basis of piece. If for 1 unit, if it is 2 hours, so what is the number of units that you are manufacturing? You are manufacturing 10 units, sir. So for 10 units, what will be the total time? 20 hours. And what will be the wages now? The rate is given rupees 100 per hour. So your wages will be 20 hours multiplied by rupees 100 per hour. So rupees 2000 that you will pay as wages. So this is an important point. This is an important twist that the ICI can do in case of piece rate. And this individual, this part as an individual can be asked as an MCQ. Right? This part as an individual can be asked in the MCQ. So this is about time rate and piece rate. Is this part clear, everyone? Please let me know if this part is clear. Then I will go to the next incentive schemes, that is Halse plan and Rowan plan. First, I want to know if this much part is clear. Yes. What about rest of the people who are online? Okay. Done. If this is clear, let's move to the next part then. Next we have is Halsey and Rowan plan. Now what Halsey and Rowan plan says, that in case of Halsey and Rowan plan, what you need, in case of Halsey and Rowan plan, you need three things, right? The worker says, sir, I need something extra. Why? Or as an employer, you would like to pay a certain incentive to the employee, certain bonus to the employee, right? The bonus is paid to the employee. When the bonus is payable, the bonus is payable if you have asked the employee that to manufacture 1 unit of the product, time allowed is 6 hours, right? You give to the worker a piece of a work and you say the work should be completed in 6 hours, but the worker is so efficient that the time taken, actual time taken by the worker is how much? 5 hours only. That means the worker has saved a certain time. Time saved 1 hour. Isn't it? Time saved is 1 hour in this case. Now the worker says that, sir, I have saved 1 hour. You will say, okay, very good. For this 1 hour, I will pay you bonus. Right? So Halsey and Rowan plan, so that this bonus works as an incentive for the worker. So this Halsey and Rowan plan deals with this bonus payment only. Halsey plan says how the bonus or how the wages will be paid. According to Halsey plan, the wages are being paid. The wages are being divided into two different parts. One part is time taken into wage rate. This is your normal wages. This is your normal wages, right? The worker is working for 5 hours, actual time taken 5 hours into whatever is the wage rate. Plus for this time saved into wage rate, for this 1 hour, he is asking for a bonus. For this 1 hour, he is asking for a bonus. But for this 1 hour, he is asking for a bonus. But you have to be careful here. But you have to be careful here, sir. What careful? The Halsey says, do not pay full bonus for this 1 hour. Otherwise, what employee will try to do? Employee will try to complete this task in the less time so that the time saved is more, so that the bonus is more. Right? Incentive, giving incentive is good. But Halsey says, do not transfer 100% of the amount as bonus. They say give only 50% of this amount as bonus. So this second is what? This second is the bonus being paid. That is time saved into wage rate into 50%. Clear? So only 50% you have to pay. Sir, will it be always 50%? If the question is silent, it will always be 50%. But if the question specifically mentions something else, this 50%. If question silent, if silent, then we have to take always 50%, else as given in question. It can be something else which is given in question. Sometimes they might say that according to Halsey, you have to pay only 40% as bonus, only 30% as bonus. This percentage may vary depending upon the information in the question. If nothing is mentioned, then it will be 50% always. Clear? This is your Halsey plan. Now, the Rowan plan is slightly different. The Rowan plan is slightly different. The Rowan plan says what? See here, if instead of 50%, some other percentage is given in the exam, take that accordingly. I have given it already. So Rowan plan says, okay sir, normal wages will remain the same. This plan says the normal wages will remain the same. Normal wages, that is time taken into wage rate, not time allowed. This is what we call it as time allowed 6 hours, time taken 5 hours. So normal wages will be paid for 5 hours. We'll pay the normal wages. What about the remaining 1 hour? Say we will pay this bonus, we will not pay directly 50%. We will pay the proportionate bonus. What is proportionate bonus? Proportionate bonus says that if for 6 hours, the time saved is 1 hour. If for 6 hours of time allowed, your time saved is 1 hour. So what is the proportionate time saved for 5 hours? So 1 is what? Time saved. Can I write it as time saved divided by time allowed into time taken into wage rate. This is what you have to pay it as bonus. Right? This is what is taken as bonus. The proportionate savings will be paid. Not for the full 1 hour we are going to pay. We are going to pay it for the proportionate hour. Thank you, Lakshay. Thank you so much. All the best for your results. Yes, that playlist is good for CMA also. And Lakshay, please drop in the Google review. I have already pinned the message. In the pinned message, you can find the Google review. So please drop in the Google review also. And share with your friends. Okay, so this is how the bonus is being paid under the row 1 plan. Right? Time saved divided by time allowed into time taken into wage rate. Clear? So this is 2 plans, Halsey plan and the row 1 plan. Halsey plan, row 1 plan. Now there is one very interesting fact here. They say when the time taken is exactly 50% of the time saved. Time taken is 50% of the time saved. The wages under both the plans will be same. So what we are saying is, when will the wages under both the plans be same? If the time taken is equal to 50% of the time saved, or the time allowed also 50%. It will be 50% anyhow. Right? Then wages under the, it will be 50% of time allowed, sorry. Change it to not time saved, it is time allowed. Right? If the time taken is 50% of time allowed, 50% is time taken, 50% is time saved, then wages under the Halsey plan and the row 1 plan will be same. Now, based on this just one relation, they can ask an MCQ. They can give you the information in such a way where this relation is to be used. Clear? So you have to be careful with this thing. Is that clear, everyone? Halsey and row 1 plan is clear, and this systems of wage payment is clear. Please let me know if this much part is clear to you. Yes, everyone, please let me know if this much part is clear. Yes. Oh, Shreyas, you are here. Replying by the end of class. Okay. Now, there is one small concept on labor efficiency. One concept, small concept on labor efficiency. Labor efficiency means how efficiently your worker is working. Right? There can be 2 scenarios. One is based on time, another one is based on output. The time says that the standard time you have given, you are giving a standard time to manufacture a unit, that is 6 hours, but the worker is taking the actual time of 7 hours. So will you say the worker is efficient? No, the worker is not efficient. So in this case, how we calculate? Standard time divided by actual time into 100. This is based on time where we can judge the efficiency of the worker. Next, based on output. Okay, yes. Based on output, right? So based on output is what? Actual output. Now you are saying to your worker that worker in 1 hour you should be manufacturing 10 units. But in 1 hour the actual production that he is doing is 8 units. Will you say he is efficient? This is actuals. This is standard. This is standard. Right? So will you say here that the worker is efficient? Definitely not, sir. So in this case, what we'll do? Actual output divided by standard output into 100. So in case of time, we say the standard time should be more, actual should be less. So what should be more should be in the numerator. What should be less should be in the denominator. So standard time, if it is 6 hours, you take 5 hours actual time. That is good, sir. That is good. The efficiency will be high. So standard time by actual time. When it comes to the output, we are saying the actual output should be more than the standard output. So we take the actual output in the numerator, standard output in the denominator into 100. Right? So this is a small concept on labor efficiency. Do not confuse between standard and the actual. Just remember one simple logic. What should be more should be in the numerator. In case of time, standards should be more, actual is less. That is more beneficial in case of efficiency. So standard time by actual time. When we talk about the output, actual output is more than standard output, then it is more efficient. Then so actual output divided by standard output into 100. Is that clear, everyone? Efficiency concept is clear. Then we'll move on to our last topic, that is labor turnover ratios. So we'll be moving on to the last topic, that is labor turnover ratios. Efficiency part is clear. That is same. In case of standard costing, there we make a difference between standard hours for actual output and budgeted hours for budgeted output, but otherwise standard and budgeted means the same. Otherwise standard and budgeted means the same. Okay, so let's come to the last topic, that is labor turnover ratios. Now, what is a labor turnover? Labor turnover tells us that in a particular period, how many times our labor composition changes, means our labor is staying in the factory for a long period of time, or the labor keeps on changing. Today a worker joins, after 2 days he is leaving the factory. Another worker joins, after 10 days he is leaving the factory. So how quickly our labor composition is changing, whether labor is staying with us for a long period of time or whether the labor leaves the factory very early, right? So this is very important for a business to know what is the labor turnover. How quickly our labor is leaving the factory, joining another competitor, new labor is being hired. Why it is important for any business to know this? Because there is a cost associated with the labor turnover. What is the cost? If I talk about the cost associated with the labor turnover, let's say if the labor turnover is very high, the workers are leaving after every few days, the workers are leaving the factory. That means there is some problem with the environment of the factory. Something is there, they are leaving again and again. So what is the cost associated? The hiring cost is associated. Hiring cost. Now every time you will have to hire the new employees. For hiring the new employees, there will be a recruitment drive. You will have to give the advertisement in the newspaper. So hiring cost will be there. After that, when you are hiring the new employees, the training cost will be there. Training cost will be there. So it is very important for a company to know that what is the labor turnover? Is it too high? Too high means the labor is leaving our place very frequently, right? Very frequently they are leaving. In this, there are a few terms which are important. The first term that we are having is number of separations. The first term that we are having is number of separations. Number of separations is simply the employees leaving the factory. Employees leaving the factory. So there can be two reasons, whether they are leaving on their own or whether it is because of our dismissal. We are kicking them out, right? So for any reason, if the worker is leaving the factory, it will come under number of separations. Then the second term that we have is number of replacements. Number of replacement is what? There is a worker A, there is a worker B, right? Both of them left the company. Now in place of A, in the chair of A, we have placed C. In the chair of B, we have placed D, right? So C has replaced A, D has replaced B. So C and D is called as replacements. If the new workers come and sit in the chair of the old workers, they are replacing the old workers, we call it as replacements. Then there is a term called as number of new joinings. Number of new joinings. Now new joinings is what? Worker A left the firm, worker B left the firm. So there are two empty chairs now. In place of A, we have C. In place of B, we have D. But now we feel we need one more employee, right? We place one more chair here where we make E to sit, right? So in this case, this C and D is what? This C and D is your replacements. That is, they are replacing the old employees. This E is what? This E is your new joining. He is not replacing anyone. He is sitting on that empty new chair, right? And the total of replacements and the new joinings, we call it as accessions. This is called as number of accessions. Clear? Replacements plus new joinings, we call it as number of accessions. Is this clear, everyone? Right? So these are the basic terminologies. Based on this, we have the different methods. Replacement method says number of replacement divided by average number of workers. So on an average, if in a particular period, the average is what? Average is opening plus closing divided by 2. Right? At the beginning of the period, how many workers were working? At the end of the period, we will see how many workers were working. So on an average during the period, what is the number of workers that were working in the factory? Out of that, how many were replaced? So number of replacement divided by average number of workers. Separation method says number of separations divided by average number of employees into 100. Then there is a flux method. Flux method says, flux method is what? The flux method is total number of replacements plus number of separations divided by average number of employees, or if there are new joinings also, then we will take number of replacements plus number of accessions, plus number of sorry. Replacement, change it with the separations. Make the amendment here. Number of separations plus number of accessions divided by average number of employees. So what is the accessions part? The accession is number of replacements plus number of new joinings. That is what we call it as accessions. Right? So there is a cost which is involved for the labor turnover. That is why the businessman is interested in knowing that how frequently the worker is leaving the factory. If the workers are leaving factory too frequently, then that means it needs to be checked. There is some problem with the environment of the factory. It needs to be checked, because every time then hiring cost will be there, advertisement cost will be there, training cost will be there, loss of production will be there, loss of sales will be there, loss of profit will be there. So many factors will be there. Okay, everyone, is this clear? Labor turnover ratios. Now this labor turnover ratios is again very, very important. From this chapter, if I talk about, two parts are very important. One, Halsey-Rowan plan is important. Second, this labor turnover is very important. Third, overtime is important. This is the order in which they have been asking the questions, maximum questions from Halsey-Rowan or labor turnover, then the overtime part. Okay, let me know everyone if this is clear. Any doubts in this part? So with this, our major concepts of the labor costing is done. Right? So major concepts of the labor costing is done with this. Let me know if you have any doubts. No doubts. Then done for the today's session. Tomorrow, first half, we'll be doing the labor costing questions. We'll try and complete the labor costing. Selected questions we'll do. One question on labor turnover, one question on overtime. Right? We'll pick up. Illustration number 4 and 5 we'll do. One on labor evaluation we'll do. So we'll pick up the selected questions. One question from each topic we'll pick up. The important one, we'll discuss the adjustments and we'll be done with labor costing. Then we'll try second half, we will start with overheads costing. No doubts. Okay, fine. Then we are done for the session. Anyone else having any doubt? All those who are live? So please do the revision side by side. That is going to be a very, very important part. Try to revise the subject side by side so that in the next days, whatever the days we are going to spend here, your subject is almost ready. Conceptually, you are very, very strong. After that, some question practice is left. You can do just the question practice, right? So no doubts are there. Okay, then we are done with the session. Then we are done with the today's session. See you guys tomorrow, 6 p.m. same time, 6 to 9. The topics will be labor costing and then we will try to do the overhead costing also, right? So see you tomorrow. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.